Stocks sell at silly prices from time to time. It doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act.
Here's the man. Many of you probably know him, Warren Buffett, also known as the Oracle of Omaha for his extraordinary insights into business growth at the age of 92. He's the CEO of Berkshire Hathaway, one of the largest companies in the world. Warren Buffett is widely regarded as one of the greatest investors in the world, and this can clearly be seen through the returns he has achieved since taking over Berkshire Hathaway in 1965. Currently, he averages about a 20.1% annual return, while the stock market averages about a 10.5% return percentage-wise. During this time, he has made an incredible 3.6 million % return, whereas the market has only yielded about a 30,000% return during the same period. Today, we'll take some time to listen to Buffett's advice specifically applied to the current economic landscape we're seeing in 2023. So, what's the market situation? Throughout 2022, the markets dropped by over 20%, and there is still significant inflation, but fortunately, it is starting to trend downwards, and interest rates are rising, with the Federal Reserve stating they won't stop raising interest rates until they reach a targeted 2%. This implies a high probability of a recession in 2023. The first challenge we need to address as long-term rational investors is what to do during a market correction period.
What about the fact that the market's down almost 800 points this morning?
Yeah.
Concern for you?
Well, no, that's good for us, actually. I mean, we're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow. When stocks are down, we're going to be buying on balance. And who wouldn't rather buy at a lower price than a higher price? People are really strange on that. I mean, because most people, most of your listeners are savers. And that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price. And they have that feeling that they just feel better when stocks are going up.
We can truly understand how rational and experienced Warren is. So, if you're a long-term investor under the age of 55, you're probably still working to build your wealth, which means you're a net buyer. In other words, you should buy more stocks instead of selling. In fact, you want the market to go down rather than up, so you can purchase stocks at discounted prices. However, if you're above the age of 65 and working on retiring with your investments, you become a net seller, meaning you want the market to go up. The truth is, most people are highly emotional and prefer to jump on the upward trend rather than buying when prices are down, even though it's the opposite of what makes sense. There's a great saying that the stock market is the only place where people run out of the store when there's a sale. And interestingly enough, we can see this effect during the Black Friday holiday when people fight over items in the store. But with the current Black Friday in the stock market, you can see how people are selling because stock prices have dropped.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes
selling
down?
a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, I'll pay you 15, you don't sell it because the quote's 15. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. If you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going down, it's going to go down sometime if you own a stock, so why worry about it? I mean, the point is to buy something that you like at a price you like and then hold it for 20 years. And you should not look at it day to day. If you bought a farm or apartment house, you wouldn't get a quote on it every day or every week or every month. So it's a terrible mistake to think of stocks as something that bob up and down, and that you should pay attention to those bobs up and down.
These two short videos demonstrate that the key to dealing with a market correction or a bear market is to own great businesses. They emphasize not to worry about the market going down because it's a normal occurrence, and you should be happy rather than fearful when it happens. Now you know how to invest during a correction. But how do you deal with inflation when prices are rising for both investors and businesses? What should you consider during a period when prices are increasing throughout the economy?
Many years ago that it's an invisible tax that only one man in a million really understands. The best investment against inflation is to improve your own earning power. The best passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency. But it's interesting, in the United States, the value of the dollar since I was born has declined by 94% to 6 cents. But things can work out pretty well even during inflationary times. I mean, if somebody told me when I was born, that the dollar bill is going to go to 6 cents, I might have said, let me go back. I'm not interested in emerging into that kind of a world, but actually it's worked out pretty well, so I have no complaints.
There are a few things to understand from this video that will make things clearer. Firstly, the best thing you can do during an inflationary period is to actually enhance your earning power. In other words, make yourself more valuable. This way, your earned income actually increases alongside inflation. Secondly, it's a passive measure, and it's about finding a really high-quality business and continuing to invest in it, much like what Buffett discussed in a letter to his shareholders. He stated that the best businesses to hold on to are those with the ability to easily raise prices, even if there is no demand, without fearing a drop in market price or loss per unit. The second point is that they can allocate more money for growth without extensively dipping into their own reserves. Let's take an example to illustrate this. If we consider a social media company like Facebook compared to an automobile company like Honda, it's much easier for Facebook to increase its revenue by posting another ad or two. However, producing more cars for Honda is significantly more expensive and challenging. Regarding Buffett's initial point, it's absolutely crucial for a business to have the ability to raise prices on their products without losing their market value or sales. A great example of this is Coca-Cola, which actually increased its sales after raising prices.
Go into a drugstore, 7-Eleven or something, and you say, I would like a Snickers bar. And the owner says, oh, I've got something, the Musk bar, at 10 cents off the Snickers bar. You say, give me the Snickers. And if he doesn't give you the Snickers, you go across the street and buy the Snickers. It's probably easier to develop a new car than to compete with Snickers. But some products have terrific moats. Probably Elmer's glue does, WD-40. People that have an iPhone, they want to continue with the product that they've got. They want the new version. It's just easier for them. They've learned how to do everything, and their life's built around it and all of that. And moats are very useful. Costco has a moat in people's mind. I mean, Amazon can raise the price of Prime, 20%, and you can't do that unless you've built something within that image of the Amazon Prime that's based on reality that you're going to get a lot for your money and you're going to want to use it. And then you can raise prices $20. But if you're selling, some commodity product, you can't do that. You need a moat.
Moats are what make a company special, unique, and irreplaceable. However, there are several unique ways a company can develop a moat. For example, if a company holds a patent, they will likely have a toll company to collect payments. This toll company has a strong moat because businesses depend on them to control the patent. Other examples of moats include branding, such as Apple, Coca-Cola, or Costco. For instance, Costco stands out for offering the best prices. Having a solid moat allows companies to have the flexibility to set prices as they wish, thanks to consumer dependence on their products. This means that during times of high inflation, they can raise prices and still have a significant number of people purchasing their products. So, you've now learned how to approach investing during a period of high inflation. But what about interest rates? How do they impact your investment strategy?
Interest rates, basically are to the value of assets what gravity is to matter, essentially. And if I could reduce gravity's pull by about 80%, I'd be in the Tokyo Olympics jumping.
Investing becomes easier when you can compare it to something, much like Warren Buffett did when he made a comparison to gravity. Buffett explains that when interest rates are low, money is more accessible, leading to more spending, more profit, and more growth. And this is exactly what has happened over the past 10 years. However, when interest rates rise, loans become more expensive, paying off debts becomes harder, and consumers have less to spend. This is one of the major reasons why stock prices tend to drop during such periods. If we look at the market since 2018, we can see that interest rates went up, and the market remained relatively flat. But in 2019, rates went down, and the markets went up. And when COVID hit, the market dipped. However, as soon as interest rates declined again, the market soared for the following 2 years. In 2022, interest rates skyrocketed quickly, and the market dropped just as fast, by 20%. One reason for the drop in stock prices is poor performance due to lower sales, making the business less attractive. However, the other reason involves government or treasury bonds, which are considered risk-free returns. The way they work is that you lend money to the treasury for a set period, and when that time is over, you get all your money back plus interest. It's not a very appealing choice when interest rates are low, as you can likely get a better return with a high-interest savings account from a bank. But when rates are high, the interest on bonds also goes up, meaning you get a better return on your investment. While this may not mean much to you, it means a lot to 80% of investors in the market who are trying to keep their clients happy. They aim to achieve returns with limited risk. So, when interest rates rise and bond rates increase, they quickly sell their positions and move into bonds, which in turn causes the prices of stocks to decline. Buffett talks about it here.
1882 or 3, when the long government bond got to 15%, a company that was earning 15% on equity worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices.
If a business is offering a solid 10% annual return, everyone would be happy. However, as the bond interest rate approaches 10%, you start to see people leaving that business and moving into bonds for safety, which causes stock prices to start falling. As an individual investor, you should remain focused on business performance during this time and ensure that you always maintain a long-term perspective throughout history. Stocks generally prove to be a better investment than bonds, but that's not always the case in the short term when you're planning your investment path. Remember that lower prices mean an opportunity for you, which leads to long-term rewards. Also, keep in mind that there's nothing you can do about the Federal Reserve and their interest rate choices. Therefore, continue to focus on selecting great businesses during these opportunities. Now, you know how to deal with some of the biggest investment challenges, such as a market correction, high inflation, and rising interest rates. I hope you've learned something from this video. If you have, don't forget to like and let us know in the comments how it has impacted you. And if you enjoy these types of videos, be sure to subscribe to the channel.